My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey kids, welcome back. Today, another exciting episode, a different episode today because our special guest, Kevin Bupp, is a very accomplished real estate investor himself. He's also an author, a cash flow investor. You can see in the background if you're watching this on YouTube. He's a fellow podcaster. He's been running his show for, I believe, 12 years now, which is a long time in podcast years. And what's really fascinating is Kevin and his team, they invest in two different asset classes primarily. One we've heard quite a bit about, which is mobile home park investments. That's very, very interesting. The other one we haven't heard very much about. In fact, I'm scratching my memory banks here. I don't think I've ever interviewed anybody who really focuses on parking lots. So that's the other asset class that Kevin and his team at Sunrise Capital invests in, is parking lots. So Kevin, looking forward to our conversation. Welcome to the show.
Yeah, Dave, thanks for having me. I'm excited to be here and excited to talk about parking lots today.
Yeah. So first things first, we're recording this at the very end of 2025. What does the portfolio currently consist of? I know you invest in those two asset classes. How do they kind of balance out? Where are they? How many of them do you have? That kind of stuff.
Yeah, it's a great question. Yeah, so to your point, we like to stay our lane and just become experts at one, maybe two things. And at this point, it is two things. Mobile home parks we've been buying for 15 years. So been at it for a very long time, way before everyone knew what a mobile home park was, or maybe even thought about investing in them. And then parking came into our portfolio about 6 years ago, and we've been steadily buying it every year. But as far as the proportionate makeup, it is the majority of mobile home parks. We've been doing it a lot longer. So we've got about $100 to $120 million of parking assets inside our current fund, and about $300 million of mobile home parks. So again, the majority is made up of mobile home parks, but for the most part, because we've been doing it so much longer, we're typically buy and hold investors. We've gone full cycle on many deals, but I would say that a lot of what we buy and a lot of what we look at, especially over the last 5 years, is more with a buy, fix, and hold mentality, and we've structured our funds around that idea, and that they're not making either one of these asset classes anymore. They're not building new mobile home parks, and they're not really making new parking, especially in the type of markets we're buying in. And so when we find a great asset in a great location, we want to find a way to buy it, improve it, but then also hold it for a very long period of time because it's deemed to be what we feel is irreplaceable real estate.
Yeah, well put. I like that term, irreplaceable real estate. Plus, yeah, they're not making any more of it. So let's just briefly take a look at, you've been in the mobile home park biz for 15 years. What do you love about that? You kind of touched on it, they're not making any more of it, but big, broad strokes. What do you and your investors love the most about mobile home parks?
Yeah, it's a great question. Yeah, so to your point, it's got a limited supply, which that limited supply creates a huge barrier to entry. And so, we know when we find a great asset that we feel is in a great market, and that's got that market's got a high demand for affordable housing, which is the product that we're offering. That's a housing product that we're offering. We know that we don't have to worry about an oversupply coming to that marketplace. We don't have to worry about a competitor building another mobile home park right down the road. And there's not many asset classes that you can have that argument on. Right. If you build a multifamily apartment complex, I think we're seeing that in some markets today over the last couple of years. Phoenix was overbuilt. Las Vegas was overbuilt. There's a number of markets in Florida that were overbuilt, oversupplied with new product. It takes time for that to get absorbed, and those that have existing product suffer for a period of time. We don't necessarily, we don't have to worry about that. And then, on top of that, mobile home parks, as a result, have had a higher same-store NOI growth or compounded growth year after year, higher than any other asset class as a result of that. Again, like you got the supply-demand imbalance that's basically working to our favor. So there's not a period of time where demand has gone down, and it's continually kind of flowing with a supply that's continuing to go down. So you got a higher demand, and a lowering supply, and it creates what we perceive to be a perfect storm. So that's just one of the reasons. But I think there's another cool aspect of it. I've been in the affordable housing space my entire investing career. I've been doing this for about 25 years now, and there's something also cool about mobile home parks in that we can do financially well, but also do socially good at the same time. So like you can kind of pair the two together, and it's pretty neat to be able to offer a really nice product. One that I feel in any market that we own parks today, it is much nicer than that of maybe a 90s or vintage apartment, or maybe the single family home that's on the wrong side of the track. We can offer a much nicer product than any of those to a new family, to someone that's looking for an affordable place to live that's clean, safe, and quiet, for typically 20, 30, sometimes even 40% less than those other comparable products. And so we can kind of give someone the American dream at a very affordable price. So it's a good feeling at the same time, while we can also provide great returns to our investors.
Very, very cool. All right. Well, thanks for giving us a synopsis of that asset class. Now let's talk about parking lots, because like I mentioned, haven't interviewed very many people, as in zero, who invest in parking lots. So I'm fascinated around that. Zoom out, big, broad strokes. What do you love about this asset class? What do your investors love about it? And kind of how does it work?
Yeah, no, it's a great question. And it's got a lot of similarities, and it's, we're always, we try to avoid chasing shiny objects. As I like to say, we stay in our lane. We had only invested in mobile home parks for a decade. We've, obviously there's many other asset classes that do great. I love self-storage. I love assisted living. I love all those, but it's very difficult to be great at all things. And so we always really stayed our lane. But ran into it or learned of it about 8 years ago, and then studied it for a number of years before we actually made our first investment back in 2020. And saw a lot of similarities. One of the big glaring ones was that it's the only other asset I know of outside of mobile home parks that actually has a diminishing supply, meaning that there are more parking lots that get redeveloped into something different. And there's no new parking being built. And so lots of cities have a moratorium on new parking assets. You can't just go tear down a building, turn it into a surface lot. You might be able to tear down the building, but you better have a plan in place, an approved plan in place with permits to rebuild something else. So you can't just go, knock a building down like you might have been able to do in the 80s, turn it into a surface parking lot. The cost of labor and material nowadays, even if you had land to build a parking garage, very difficult to buy one to where the economics would make sense. So a lot of the parking garages we buy for below replacement cost in markets that have a limited supply, massive barrier to entry. And so we kind of look at it as it's an opportunity for us to buy what we like to call, again, irreplaceable real estate and very densely populated growth markets. And have a cash flowing asset on top of a piece of dirt that we know inevitably at some point in time will have a higher and better use. We don't underwrite the future use. It could be 10 years, 15 years, 20 years, whatever it might be. We know parking is the highest use today, and we can make the economics work. We can make the cash flow work. The business model looks great as parking. But we know that whenever that day comes, if parking is not the highest and best use, that there will be something else that will be even a greater use than that of parking. So parking is like the lowest use it could ever be because of the location of real estate. So it's just a cash flow covered land play in just phenomenal areas. So just give you an example, the last parking garage that we just closed, we closed on it's been about 5 months now. It's one block from the Liberty Bell in historic Old Town Philadelphia, 2 blocks from Independence Hall. Those tourist destinations have been in demand for hundreds of years, and I would anticipate that they're going to be in demand for hundreds of more years, right? Like they're not going anywhere. Right. It's a thriving area. There's no new parking. There's no new room to even put parking. There's a limited supply. There's not enough street parking, not enough off-street parking there to serve the cars and the traffic that's already there. And so, we can buy that asset on a block knowing that inevitably when the time comes, we've got air rights there that whether it's be 30 years down the road, we'll build a tower, build a multi-use property, a hotel, whatever the highest and best use might be at that point in time. But until then, we'll enjoy the cash flow from parking.
So I think you mentioned that, you touched on it. It's like it's cash flow land banking is kind of what it is.
That's right. Yep.
Yeah. Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. Very, very smart. Okay. So logistically, are these typically like parking garages in big cities like we envision, like there's a structure there and multiple stories of the spirally thing where people are parking? That's kind of what these things look like?
It's both. So we own parking garages, like you just referenced, multi-story, concrete structures, sometimes 3 stories, sometimes I think we have one that's 8 stories. Everything we own is in a big city, in a larger city, larger growth city. But we also do own surface parking lots as well. So just like what you'd envision, a asphalt surface parking lot with maybe curbs in a downtown, central business district. Same type of location, but the majority of our portfolio is parking garages because that's just more common in those areas. But surface parking lots, we love just as much.
So logistically speaking, how does the business side of that work? Do you lease these out to companies that specialize in collecting the parking fees? Do you guys do that yourself? How does that side of things work, Kevin?
Yeah, so it's a great question. So we have a vertically integrated property management company in-house. However, a vertically integrated property management company only specializes in mobile home parks. And so we've got about 50 staff members on that side. It's called Sunrise Communities. But mobile home parks, managing those is very different than that of managing parking. And so we work with a variety of both local, regional, national parking operators across the country. There's lots of companies, a number of that are publicly traded. And so every market's a little different. We try to find the best in class, local management company. Most of the time, we just work with them on a management level, meaning that they're handling the day-to-day management. We have in-house asset management. So we still have a handle on the pulse of what's going on. We're still very involved in it, but we're not necessarily employing those that are, managing the collections or running the gates or, doing parking enforcement on the localized level. And so we do have a few assets that we actually lease to a parking management company where they just pay us a triple net lease. We're happy with the lease. They handle the taxes, the insurance, the monthly payment, all the repairs and maintenance and everything. And that's good as well. It's all case by case. Really for us, we want to do what's best suited for not only just the asset, but also our investors and what the long-term business plan looks like for that property. But it's interesting because in theory, parking is very simple. You got a person driving in, they pay, they drive out. It's a lot more complex than that. There's dynamic pricing based on times of day, based on events that are happening. There's also a variety of who's parking there. We've got monthly parkers that pay a subscription fee. We've got hotel valet. We've got local stores in the area that we have, basically validation programs with. We've got transient parkers that are just folks that are visiting the area for a short period of time. And so each one of these has different pricing structures and it becomes very complex in nature. And so for that reason, a lot of these parking management companies we work with, this is all they do. They're a management company. They've got, a lot of them have very robust technology platforms that manages all this. And for us to actually replicate that and do it better, it would be very difficult for us to actually compete and actually do a better job than what they can do. So we keep the asset management in-house, and then we outsource the actual day-to-day property management.
So when you outsource that, do you do like a revenue share arrangement with them, or is it a flat? How does that side of things?
So again, it all depends on the property. Well, we've got, I believe we have like one revenue share program in place. So there's like a base threshold, and then if they actually surpass that threshold, there's a revenue share in and above kind of what the initial target is, just really to incentivize them to push harder, right? To really create an alignment of interest that ensures that they're not doing just the bare minimum. So revenue share models are great if you set them up correctly and if you dangle the right carrot, because a lot of times you can actually squeeze a little more juice out of that property.
Very, very cool, Kevin. So it's sounding very, very appealing. Nothing is ever, like you mentioned, as simple as it seems on the surface.
No.
Nothing is ever sunshine and roses 24/7 either. So what are some of the not so great sides of investing in parking facilities?
Yeah, I mean, it's a great question. So, we there's lots of parking investments that we don't buy, that we pass on. Probably, we give or take, we probably look at about 30 or 40, maybe even 50 to find one that checks all of our boxes. And so one of the not so great things, and I wouldn't necessarily say it applies to us, we typically steer clear, is that a lot of parking, especially parking garages, if they're in like downtown business districts, a lot of them were purposely built, in the last, you call it 20, 30, 40, 50 years to predominantly service office workers, and then also these, surrounding businesses that support those folks that are going to the office. Well, as you and I both know, there's lots of cities within this country where office is challenged right now. The occupancy levels are at all-time historic lows. And so parking garages, there's a lot of folks in the parking industry that are suffering a great deal today. In fact, we've been able to pick up some of these great opportunities because of that, but to where the majority of their demand drivers were driven by office tenants. And if there's not a variety of demand there outside of the office tenants, and it's kind of a nail in the coffin. There's no solution how to fix that. It's a much bigger problem. So for that reason, when we look at a parking property, it's got to have at least 5 unique demand drivers. And if, it could be, local nightlife, it has to be a 24/7 city, sports and entertainment arenas, nearby vicinity, courthouse traffic. Office can be one of them, but it's got to be the lowest of all 5. And so meaning that if it continues to suffer, it's in a market where maybe that office might additionally lose additional occupancy, that we've got 4 other demand drivers that are going to support that garage. And we typically underwrite that office isn't going to do much better than what it does today. And so if it does better in the next decade, then inevitably we'll do better. There'll be some upside, but we tend to steer clear. So we saw a lot of folks during COVID that own garages that were tied to office occupancy and absolutely lost their shirts, as you can imagine. And so, but I think it's very similar to that of any asset class. So like even in mobile home parks, like I would never buy a mobile home park, even if I could buy it for a great price and what seemingly was a great return or great cap rate going in, if it was in a town where there was only 2 employers or 3 employers, right? Because if one of those employers leaves and now, where are folks going to work, right? Like they have to, in order to pay the rent and have a roof over their head, they've got to actually have employment. If there's not enough employment in that town, guess what? They move out of that town. So kind of the same thing with parking. I want to know that I've got a variety of demand drivers, that if one dries up, that I've got a few others backing it up.
Wow. Yeah, that makes a ton of sense now that you explain it like that. That's for sure, Kevin. Interesting stuff. Now, do you own any assets like in the northern states, any of these parking garages in northern states where you get a lot of snow? You got a lot of, salt. You got those kind of things that can cause challenges to the structures. Is that ever an issue?
That's a great question. So Philadelphia, they get snow, not as much, maybe as where you're located, or anywhere as much as like once you get up in like the Midwest, like, Michigan and Minnesota and those states. Pennsylvania is the furthest north that we own. However, we have an asset in contract now in Boston. So obviously Boston gets quite a bit of snow. We've had a number of deals in contract over the years. In fact, I'll give an example of one, and I think it goes in line with why you're asking this question. Parking garages are made out of concrete and steel rebar for the most part. Right. Like that is it. And concrete is porous, and if it's not maintained over time, water seeps in, salt seeps in, and we all know what water and salt does to steel, right? It erodes it over time. And we had a parking garage under contract in Providence, Rhode Island, right in downtown. Phenomenal location. I mean, just again, irreplaceable real estate, great demand drivers, variety of them. The numbers look great, but once we really dove into the property, we got engineers involved, started doing in-depth core studies. What we found is that at a surface level, you could tell that repairs had been done, but once you started digging a little deeper, you could tell that it was just really band-aided repairs over many, many decades. So really neglectful ownership that probably was taking all the capital, not setting aside reserves, not doing proactive repairs, which you have to do if you've got that type of structure. You got to set aside a budget every year and actually reinvest in that property. And it was to the point to where we thought that it was such a high risk that there was a chance that over the next decade there could be a chance where we get shut down. And it wasn't fixable. It was so the damage ran deeper than what we could actually visibly see. And so you're somewhat rolling the dice on how bad is it, and it's not reversible at that point in time. It's too deep. The damage runs too deep. And, now you got a safety risk. Now you have a risk of actually being shut down by city engineer, city inspectors. And what does that mean for the business model? So for that reason, while it was a great location and we thought we were picking up for a great price, no price is great enough to offset that type of risk. So that's a real risk, real consideration. And as we see these out, there's lots of other parking garages I've seen come online over the last couple of years. A lot of it is tied to these office buildings that are in distress. And what's happening is these owners of these office buildings, they can barely even cover their debt service. A lot of them are in distress, default. And I can promise you, they're not putting money back into the office properties. They're also not putting any money or capital reserves back into the parking garages, right? So you got these deteriorating structures that are only going to get worse as time goes on. So no matter how cheap you can buy them, it's not just an occupancy risk. It's also a structural risk that you have to take into consideration.
Wow. Okay. Yeah. Like you say, nothing's as simple as it seems on the surface. That's for sure, Kevin. Fantastic. So as we're wrapping things up, you got a darn good looking book there behind you, The Cash Flow Investor. Tell us a little bit about that, and then we'll let people know how they can get a copy as well.
Yeah, no, absolutely, Dave. Yeah, so I published a book. I guess it's been about 3 years now, and it was a labor of love. It took me probably 3 years to publish it, and it's been out for about 3 years. But it's really, I've been a investor now for 24 years to be exact. Been buying commercial real estate for just over 20. And then, as you had mentioned, I've been, doing my podcast for long before people knew what a podcast was, I guess. I used to joke and tell guests that they're like, well, where's this going to be live? I'm like, it's an internet radio show. Because if I said podcast, they had no idea what that actually meant. They didn't understand. But I've interviewed lots of great folks like yourself that are, incredibly intelligent, that are very successful in their own right and just have vast amounts of knowledge in real estate. And so I've learned a lot over the years. And there's a lot of these guys or gals I've interviewed where I've taken away gold nuggets and we've implemented into our very own business. And so basically the book is a compilation of my own personal experiences in real estate, but as well as, paired with those that I've interviewed, those that I've gotten to know over the years that have many decades more experience than I, and I've really compiled that all together in that book just to really teach folks about how to make money, how to build wealth, and just create cash flow by buying commercial real estate.
Very good. So people want to connect with you and maybe get a copy of the book. What's the best way for them to do that?
Yeah, so you can go to kevinbupp.com. That's my primary website. And then I've got a landing page as well there that I'd love to share with your listeners. They can grab a free copy of the book. It's a physical copy. You just have to pay, I think it's roughly like $6 shipping and handling. They can go to kevinbupp.com/free book and grab themselves a free real bound copy, not a PDF version or anything like that. Or you can go to Amazon and spend $20 on it, but I would suggest the $6 version is just as good.
That sounds great. Hey, Kevin, thanks so much for being on the show. This has been a lot of fun. Thank you very much for kind of unwrapping the whole investing in parking lots scenario. That is fantastic. And congratulations on the success, sticking in your lane, finding that new lane that was really quite adjacent to what you're already doing. And it sounds like you got it pretty dialed in. So keep up the good work.
Thanks for having me on, Dave. It's been a pleasure being here, my friend.
All right, everybody. See you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.